Hello, everyone. Welcome to the stock-specific class here for Thursday, March the 11th. I haven't liked a lot of stocks this week, and a lot of it has to do with kind of erratic behavior on some of the individual charts. When I talk about how stocks tend to move, they tend to move in kind of a stair-step fashion, and one of the you'll get a burst of a move, then a correction, and then a burst of a move, then a correction, and you can kind of see a flow to the chart. And the edge you have is that if you have a stock that's moving like that, is that when it's in this little pullback right here, in this little correction, you're anticipating that you're going to get that move higher, and usually when you're a trend following approach is that you're going to assume that trend is going to continue until it doesn't. And what's happening now, and that's your edge, is that you that's the pattern, that's the behavior, and then you get the move and you make the money. Well, what can happen sometimes is you get a stock that is moving kind of predictably like that. And remember, one thing I always tell you is that, and everyone will tell you, is you can't know exactly what a stock is going to do or exactly what the market is going to do. And so we understand that going into it, but we're trying to find that edge of, okay, but there are probabilities. When we see patterns like this, there are high probabilities that stock is going to go up, or there are bearish probabilities when it's likely a stock's going to go down. But sometimes what can happen is you can get a move where suddenly the stock makes a sharp move down, and then maybe it makes a sharp move back up, and it's not moving in any sort of predictable fashion anymore. It's erratic. And one of the things that I've tried to teach over the years is that when I start to see the market or an individual stock acting erratically, sometimes the best thing to do is to not do anything. Sometimes the best trade is sometimes not to trade. And you might have heard that before. It's something that's often quoted amongst traders, but it's true. If I can't feel like I've got an edge on the market, or that that I feel strongly that stock should be going up for the next 3 or 4 days or down for the next 3 or 4 days, instead of trying to guess, which is usually what ends up happening, is I feel like I'm just guessing. A lot of times I'll just take the day off, and sometimes that's hard to do when you got money in your account, and especially if you've made a lot of money recently and you want to make more. It's hard to just sit tight and not do anything, and especially hard to sit tight, not do anything if you can't really tell what's going to happen over the next few days, and the market then keeps going up for 3 or 4 days or something. Then you feel like, then you get that fear of missing out. Oh, I'm missing out on this. And you start chasing things, and you're probably getting into some of those trades a little bit late, right when they're about to reverse or pull back or something like that. It just can throw you off. So, just always keep that in mind, is that you don't have to trade. There's no, sometimes people trade like there's a countdown clock, like if I don't make a trade, then the buzzer's going to go off, and I'm never going to have another opportunity to do this again. And the market is always going to give you opportunities to make money. I always say that, but I also say, however, there are higher probability times in the market to make money than others. And right now, I'm telling you, this week, it's just had a feel like I'm guessing, and that I can't really tell what it's going to do in the near term. Now, I've talked about how overall I think the NASDAQ 100 chart is broken. I still kind of question whether that will. I still don't think it's going to come back and go to a new all-time high with the other indexes. But who knows? I mean, when you get into a kind of a crazy market condition, where you get really, really hyper buyers that are buying just to buy, it can take a little bit of time before they get crushed, and they can push the market up a little bit beyond what you think it could go. I'm going to go right over to the charts here. There's really not much to talk about in the direction alerts, and not much has really changed from when we went over those on Tuesday. But I did talk about how on Tuesday I talked about how the S&P 500, I thought the Dow had already broken out to a new all-time high, and right in here. And in fact, though, we faded a lot into the close that day. If you remember when we were talking, it was looking like it was going to close at a new all-time high, and it faded. But since then, it has closed a new all-time high, and it's up again today. It felt like the S&P 500 and the Russell 2000 were both close enough where they could break out, and we're seeing that too. There's the SPY, and now it's yet to see if it's going to close at a new all-time high. Let's look at the Russell 2000. Again, that's breaking out again today too. But it not only is it the QQQ in general doesn't look like it's lagging big time, but if you look at a lot of individual stocks in the Nasdaq 100, they look pretty bearish. They really don't look like they're wanting to participate with the rally this week. So, and you can kind of see that if you go to a little bit longer term chart. You can see how that trend has been broken. Gone over that a number of times. Now we have rallied back up, and we're kind of back up above that trend line today. We were right at it yesterday. In fact, I thought for sure that we'd see the Nasdaq 100 drop today, based off of the fact that it broke below that trend line. It rallied back up to it, then it had a bearish reversal day yesterday, where it tried to. Let's go back to that 6-month chart. You can see where it tried to open higher, or what did open higher. It was right on that trend line. You had that trend line drawing. It would come up right there, and then it closed lower than where it opened. And I thought for sure. I mean, that type of behavior right there. And that price action. I thought for sure this thing was going to drop, and then it moves up. So this is what I'm saying. It feels like I'm guessing. What should be kind of happening is not really happening. And I don't feel like I have an edge in that situation. Now that usually these conditions don't last very long. Most days I'm pretty confident in reading what the chart and price action is showing me. Yeah, it's kind of weird. And when you look at, like, for instance, the Dow, if you go look at individual Dow charts, and I don't have time to do that here, but and you don't have to go do that. But if you were to, you can see the Dow has been up pretty strongly particularly the last couple days here. But if you look at individual stocks, really the only ones that have really moved sharply upward is Boeing, Goldman Sachs. Basically, Boeing and Goldman Sachs have been the two main drivers of that move. But there's a lot of stocks in the Dow index right now that don't look great. They've moved up maybe with this rally, but not by very much. And so it is really kind of a suspicious kind of move. It feels like it's drawing people in, and it's may on the surface may look like everything's fine, but underneath it's looking like it may not last very long. It could go the other way pretty quickly. We'll see. I've had conditions like this before, where like the Nasdaq 100 looked like wasn't going to come back, and then suddenly something came out, or some reason came out for people to buy, and it broke out and went higher. But these conditions right now are typical of what you'd see at a top, and to be able to predict exactly when a top ends is pretty difficult to do. And so, and that's why it's always important to remember you're a trend trader. If we do end up breaking out higher, and okay, then trade that trend. I'd still be very cautious trading a breakout in the Nasdaq 100, because that might be the final straw for a thing to roll over and go the opposite way. And but I don't want to, you got to be careful not to, even when you are able to kind of read these, the charts and the price action, you got to be careful not to feel like you're psychic or anything like that, because the market can destroy you if you ignore what the actual trend is, what the actual market is doing. Also, keep in mind here, the Dow is at the far right side of this extreme reversal risk range. So I factor that in as well. When I'm looking at these individual stocks in the Dow, and there's only a couple of them that look like they're driving that move higher, and then you see that get to the far right side of this extreme reversal risk. That's kind of a warning sign, red flag, that this may not last very, very much longer. All right. Let's get into some individual stocks. Like I said, I didn't see a lot that I really liked. I'm going to stick to one sector. I went over a couple of these on Tuesday, and then I'll add a new one in here. But under business services down here, there were a few patterns that looked okay. I went over this Riot blockchain, the top of the list. That's a 100 strength rank here. And this is tied into Bitcoin. And with Bitcoin at all-time highs, again, it's a little tricky there. Can it keep going higher? Yeah, but if it starts to get stretched here. This is not looking like it's stretched. It's had a pretty big pullback right in through here. It switches over to signals, though. Oh, and it just went to a buy signal today. So I'm looking at this as a impulsive move up. This looks like wave A, wave B, wave C on a pullback. And a nice big up move on Tuesday, and that's why I mentioned it, because it looked like it was coming off of this possible correction here, and then went to a buy signal today. So that's one that looks interesting to me. Another one in that same group. Well, I'll go over the one I went over on Tuesday as well. FUTU, Futu Holdings, I think what it is. Is that what it is? Yeah. Again, looks like a possible ABC pattern on the pullback right there. Big run up. Had a little bit of a bearish reversal day yesterday that had the nice big up day on Tuesday. That's why I mentioned on Tuesday. Today it's kind of an indecision day there, but this has got to be pretty close to going to a buy signal as well. Yeah, it's getting there. I think any decent upward move would kind of push that to that buy signal range. And then one more, this is a little bit more of an established pullback. Same again under business services. It's this CLSK, Clean Spark Incorporated. So you had this big run up right here, and then this looks kind of like a larger kind of ABC pullback correction there. Oops. And had a nice move up off of that on Tuesday. Went from sell to hold. And again, you still want to wait for it to go back to a buy signal, and it's fairly close to going back to a buy signal. And this is what can happen sometimes too. Here was a pullback. It wasn't real. Again, on the pullbacks, I like to see a pretty distinct back and forth, and you could say that, maybe that looked like wave A, wave B, wave C, or something like that. It started to move up. Sometimes a correction can be drawn out a little bit longer. Remember, what a correction is it's indecision that's going on. That's what's creating that back and forth pattern. And the indecision is usually between the buyers and sellers. The buyers are showing you they're not as confident in their buying. The sellers, maybe it's just some profit taking, or maybe there are short sellers that are pushing the price down, but they're not real confident the stocks are going to go down. And so it gets caught up in this back and forth. And we know how to recognize that behavior, that indecision. The tough part, though, is knowing how long that indecision is going to last. In a lot of strong trends, you'll get that sharp move. You'll get kind of the ABC pullback. It'll be an initial sell-off, the bounce, the final sell-off, and then it'll take off again. But there are times where you get a stock that indecision just lasts longer, and it looks like it's starting to go back up again, and it comes back down, and you get that more drawn out sideways consolidation. Now, the behavior is still predicting the move. It's still saying that stock should continue to move up after that consolidation is over. At least that's what the probability is. But sometimes that can get drawn out for a while. And that's why I've mentioned this in the past, that even though if you see a stock that's been moving sideways for a little while, even though, you hear me say it all the time, whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's likely to go after it's done moving sideways. Even though that's true, man, if this has been 2 months of moving sideways, I don't know that I'd want to enter in, and because it could be another month before it takes off. Sometimes what I'll do is just wait for it to break out. Wait until it breaks out of that range, because that's usually when it really takes off, because it's beyond that consolidation zone or whatever. And so, but this one looks like it could be that larger ABC pattern. Again, this whole movement looks a little bit more choppy, more sideways after a nice sharp move up. And so again, the final confirmation can just be to wait for that thing to go back to a buy signal. And you'd probably, again, like I said, with Riot has gone to a buy signal, and you can make a decision on that one. But the rest of these, you're waiting for them to go back to that buy signal as confirmation. So if the markets pull back or roll over, it may not get to that buy signal. If they continue to push higher and it goes to that buy signal, then maybe the NASDAQ isn't going to sell off right here. Maybe it is going to go higher. That's kind of the benefit of kind of waiting for that confirmation. Now, and I think this brings up an important point, though, too, is if we look at the market and we see warning signs, or you see that might be pulling back, but you find a couple of charts that look like they'd be good to get into, do you wait? Do you go ahead and get in? We can't know exactly what the market is going to do, obviously. I like to look at the overall market conditions to kind of know the environment I'm in. Does it mean that these stocks I've gone over, could they still go up even if the market goes down? They absolutely could. They're the stronger stocks within these groups, and so that's why we focus on that strength rank and the pattern itself too. A lot of times too, if they may not go down if the market goes down, but they may not go down very much. I mean, you look at how far the NASDAQ has dropped, and this stock really hasn't dropped that much. It's still kind of been in this range. So you can have a situation where the market may have a big move down, but maybe the stock has a smaller move down or something like that. But I have no problem with finding stocks that I like and saying, you know what, I'm only going to trade one of those because of the conditions are a little bit sketchy right now. Or again, maybe I choose not to. The key is being able to identify these different clues that are going on, and then you can kind of make your decisions. And it still is going to come down to your trade management as well. You know, where you're going to, how much you're going to risk. Do you want to use a stop loss, you know, based off of a support area? Do you want to use am I going to stop out if it goes back to sell? You know, having your plan for your trade as well, following that plan is all an important part of the whole process. But anyway, all right, so I'm going to leave it at those three for now. And let me switch this back over to candles. And I'm going to pull up well, let's get into training. The training today is we're continuing with the option training. Last class, we went over intrinsic value and extrinsic value. We took an option price off the option chain and separated what part of that price was intrinsic value, what part of that price is extrinsic value. Today's focus is going to be more on the extrinsic value part of the option, because there's a couple things that play into that option price. So this was the extrinsic value part of the option price. There's a couple parts of that are part of that. I told you before that the biggest part of the extrinsic value is the time value, how much time there is to expiration. But a couple other key elements, or one big key element, is the implied volatility of the options. In order to understand implied volatility, we need to also understand historical volatility. Historical volatility is commonly referred to as past volatility. What has that stock done in the past? The actual volatility that occurred to the underlying stock during some previous time period. So, you know, if I can see that a stock, when it typically is up for the day, it's up $2, and when it's down $2, or maybe it's up $3 one day and down $1 the next day, and you know, if that's kind of the normal back and forth of the stock, then that's kind of the historical volatility. You know, if that stock has been just kind of moving in a range, or obviously not all stocks are moving in a range, but even then, if a stock has been trending, but it's kind of trending within a range where it's kind of, you know, even though that stock is trending, there's a pattern to it, there's a flow to it that's kind of the normal flow. Okay. By the way, don't get too caught up with absolutes in today's class. A lot of this is kind of abstract, and mostly I want you to kind of understand the concepts of what we're talking about. So that's historical volatility. Now, implied volatility, the definition of implied volatility is the value derived from the current market sentiment of the anticipated future fluctuation of the stock. I always laugh when I say that, because anyone that's brand new to option trading would not understand that definition if you were to write it out. So my job is to try to simplify it a little bit. And probably the best, simplest way to explain implied volatility is future volatility. And future volatility is often based on speculation, which is driven by fear and greed. So, you know, let's say a stock has been, you know, it's normally going up $2 and down $2 and up $2, or up $3 and down $1, or whatever. It's just kind of in that normal flow. And it has an earning announcement coming out, and there's a big expected announcement to be made. And everyone's saying there's a big announcement this company is going to make. Well, there's speculation, and that is going to be big news. Now, that news could be really positive, or it could be really negative. And so there's an anticipation that stock that's been normally moving up $2 and down $2 could jump up $5. Okay. Or it could drop down $5. It could go either way in a big way. which often happens with earning announcements, by the way. Okay, so what will happen is that market maker or the floor trader, or usually it's your broker, will increase the value of that option to account for that uncertain move. I don't know if this is going to go up big or down big, but we're expecting a big move to happen. I've got to hedge myself, that broker is saying, or that market maker is saying. And so I'm going to increase the option price, that option that was normally $2, I'm going to make it worth $4. Okay. Now, a couple things to understand here. The implied volatility can only affect the extrinsic value of the option. So let's say that option, in fact, let's change the numbers here. Let's say that the option is $7 and $5 of that option price is the intrinsic value or the equity, meaning, and you'd have to go back to last week's class to understand what intrinsic value is, but that's the equity. That option, if that stock was at $55 and you had the $50 call option, the right to buy it at $50, that option would be worth at least $5. That's the intrinsic value. The extrinsic value would be whatever's left over. In this case, it would be the $2 there. Extrinsic value. Now, let's say that big announcement's coming up, and this thing could make a big jump one way or the other. Well, that market maker might increase the extrinsic value of the option from $2 to $4, let's say. So now that option is worth $9. Implied volatility, I often use the analogy of blowing air into a balloon. If you blow the air into the balloon, it expands the balloon. If you let the air out of the balloon, the balloon deflates, right? It can be inflated or deflated. In this case, and the air in the balloon is the implied volatility in that analogy. So if in this case there's air being blown into the balloon, it's expanding, which means that option is becoming expensive. Okay, it's inflated. We call it inflated. The options are inflated. Okay. Now, the important thing to understand here is it's not saying that you can't trade that option just because it's inflated. It's that you need to understand that it's inflated because it can also deflate. Let's say they were anticipating this big move from this company. They thought it was going to make a $5 or $6 move one way or the other, and you think it's going to make that move too. You think it's going to go up, so you buy the call. You go ahead and pay that $9 for that call option because you still think you can make money if it goes up. And let's say the news really isn't that big and the stock doesn't make a big move, or maybe it only goes up $2. It goes up, but only goes up $2 like its normal pattern. Well, now that you know what the news is, now that you know what the outcome of the event is, there's no reason to keep that option inflated anymore. So that market maker they'll deflate the option. And if the move of the stock isn't big enough to offset the deflating of that option, then you could have a situation. So let's say he basically lets all that extra $2 value out of the option. That stock went up $2, right? So your intrinsic value went up to $7, right? So the stock went up to $57. So now the intrinsic value of that option is $7. Remember, he deflated the option. The option went back. The extrinsic value went back to $2 here. That's supposed to be an I right there by a 7. This would be $2 of extrinsic value. You got a $2 move of the stock. The stock went up $2, but your option didn't move at all. You bought it for $9 and it's still worth $9. That's the danger of buying an inflated option. Now, what if the stock did make a big move? Let's say it did make that big move and it went up. It went up $6. So it went from $55 up to $61. The intrinsic value of that option would be $11. And let's say that it deflated the price back down to the extrinsic value back down to $2. So let's say there's $2 of extrinsic value. That option would be worth $13. If you paid $9 for it and you could sell it for $13, you still made money, right? So again, I'm not saying you can't make money buying an inflated. Maybe an easier way to explain this is to go back to that real estate example of, let's say that that house is $100,000 and you're in a really hyper. So that's what it was appraised for. It's appraised for $100,000, but you're in a suddenly really hyper real estate market, and the person offering the house to buy the house is saying, all right, I think I can get $110,000 off of it, and you say, okay, I need a house right now, and there's all this hype to get a house because the prices are moving so fast. You say, okay, I'm going to go ahead and buy it for $110,000, even though it's only worth appraised at $100,000. Well, could you still make money selling your house down the road? Yeah, if that house continues to go up and it's $150,000 later on, I can still make money in those conditions. Okay, but what if as soon as I buy that house for $110,000, the market just dies? I'm sitting on a house I paid $110,000 for that's only worth appraised for $100,000. My chances of losing money on this thing are pretty big. Now, on the flip side of that, let's say you were able to buy that house for $95,000. You got it undervalued or at a good price. Now, if that real estate market dies, you're still okay. You're not going to get hurt by that overpriced the amount you overpaid for the asset there. Okay. So the bottom line is we just need to understand the concept of implied volatility. Now, let me give you a real good example of a stock right now that is incredibly high implied volatility, just crazy, and your chances of making money in that for that particular stock on options anyway are very, very slim. And yet people are getting sucked into it day by day. But let's take a look at, give me a second here. I got to log back into my account. And the stock we're going to look at is Gamestop. Before we look at Gamestop, let's look at the chart of Gamestop. So look at what the historical volatility of GameStop was for months and months and months and months. It was a $5 or $6 stock, and it would go up and down, barely go up and down, up and down, up and down, up and down. suddenly that Reddit group, and maybe you've heard about this by now. If not, you can go Google it and hear all the stories that's been going on for the last couple months about this group. But suddenly the stock went from $5 to $446 in a week. So this is the historical volatility. Here it was an unexpected move up. Not only that, it was an unexpected move up and an unexpected move down. It came crashing right back down. That was not expected at all. So it threw a complete chaos into the trading system, particularly for the stock. They had to halt the stock several times, and because it was not normal. Now the option premiums back here, you could have bought a call option on the stock for, when it was down at $5, you could have probably bought a call option on the stock for out probably 2 weeks for probably 50 cents. Let's see how much it would cost us to buy the at-the-money strike price, which is probably going to be right around 262, that expires tomorrow. I can buy let's look at out of the money, because there isn't one right at 262. There's a 265 call, so it's out of the money. There's no equity in the option. There's no intrinsic value. It's all extrinsic value. $21.30. That option that would have cost me 3 months ago 50 cents would now cost, and that would be $50 for one contract, would now cost me $2,130 for one contract. And it has no intrinsic value, meaning if this stock stays exactly the same or is below 265 tomorrow, you're losing $2,130. Okay, so it's crazy. You say, well, let's get some intrinsic value here. Let's buy the 260 call. All right, let's see how out of that $22,335, or out of the $23.35, how much of that is 35 cents? How much of that is intrinsic value? Well, the stock is at 262.89, and the strike is the 260 strike. So if you take out the 260 strike, $2.89 of that option is equity or intrinsic value. So that's your intrinsic value. Your extrinsic value, $23.35 minus the intrinsic value of $2.89 is $20.46 of extrinsic value. Now, am I saying that you can't make money buying an option on Gamestop? Well, let's go back to that chart. Let's see if I can go back to the chart without erasing this. I think I can. Yesterday, GameStop had a high of $348 and a low of $172. That's crazy volatility. And what's crazier is it basically opened and closed about the same right in here. Now, so could it go from 262 up to 348 again, or close to that tomorrow? It's possible, which is why those options are so inflated. But that's why it's so risky to trade it. Because if I bought the, let me get this back over to, yeah, there we go. It's all lined up here. So if I go, if I went out of the money and bought the 270 call for $19.40, again, if it made that move up to 348 again, what would be the equity on that, the intrinsic value on that? 348 minus the $270 strike price would be $78 of intrinsic value. So if it did make that run up, even if it lost all of, because it could, remember, this is all extrinsic value. This is the amount that the floor traders can play around with. This is the part of the price they can play around with, inflating it or deflating it. If it totally deflated and it lost all the amount, the whole $19 of extrinsic value, you'd still have $78 of intrinsic value on that big move up, to where you'd still make money. You'd make a lot of money on that. That'd make a ton of money. But if it doesn't get above 270 by tomorrow, you lose that entire amount. So this isn't a really extreme example, but sometimes it's important to see an extreme example, because I cannot tell you how many people have texted me, some friends and some relatives even texted me about GameStop. Jerry, should I buy a call option on GameStop? And my advice is stay away from that. And the funny thing is that move yesterday, that extreme move, was on no news. There was nothing. So it was just pure speculation by these traders that are trading it right now. So again, by understanding how that extrinsic value and that implied volatility, you can understand that it helps you to make a decision on, do I want to take that risk? I need to know what the risk is. If you're just running out and buying that out of the money option on GameStop, you better understand what your risk is. And now, again, I can't lose more than what I'm paying for the option, but there's a very low probability, because even if the stock goes up a little bit, there's a low probability that trade's going to work out for me. And if it goes down at all tomorrow, and it's down a little bit today, it's down $2 today, you're going to lose a lot of money on that. Now, real quickly here, let's look at Amazon. Now, Amazon's options are expensive as well, as far as how much they're costing you. But there's a difference between expensive and just the price, and expensive as far as overvalued, or that's having that speculative value in them. Because not only are those GameStop options expensive, but they're inflated. On Amazon, their options are expensive in cost, but they're not inflated. So now there's still a little bit of risk here that if I bought the out of the money 3,120 strike on Amazon, it's going to cost me $1,800. But this stock moves, the historical volatility on the stock is it moves up or down $60, $70 a day. That's pretty normal. In fact, let's look at the chart. See, this is just kind of the normal movement. It moves up and down these large amounts every day. So that option is not inflated, but it is expensive as far as the cost, and that's why I don't have a lot of students that I teach that trade Amazon very often, because those options are so just kind of, well, it's not just because they're expensive, but there is that risk there. Even if you think that Amazon's going to go up, it's going to cost you $2,055 for one contract, and if it doesn't work out, that's a $2,000 possible loss, or it could be a $1,000 loss if it drops half its value before you can sell it. But it's not an inflated price, though. Now you can see, another extreme opposite of this would be something like Bank of America. It's lucky if it moves 20 cents in a day or 25 cents in a day or something like that. So if I wanted to go out till April even and buy a call option on and I could go a little bit in the money here, or this would still be considered right at the money, but I could buy the 37 strike call out till April, and it's $1.28. But that's not inflated either. Now, Bank of America, though, could get those options could inflate a little bit on Bank of America. If it's right about, and it does, right around there. Most times when options get inflated are right around the earning announcement. I wouldn't trade too many earning announcements. There again, you hear me talk about having an edge. I've seen stocks report fantastic earnings and drop way down after their earnings report. I've seen stocks report terrible earnings and make a big move up. And then I've seen stocks report great earnings and go up, and terrible earnings and go down. It's just, it's too erratic. I don't have an edge there. It's more of a gamble. And then on top of that, if you're trading options, not only do you not know what direction it's going to move in, but you can pretty much be assured that those options are inflated for that uncertain move. And they are. Every earning announcement, those options, you can assume that those options are inflated. Those market makers are going to increase those option prices to offset that uncertainty of the move. Now, it's just not earning announcements. Earning announcements are known events. You know when they're going to happen. But other events that you know about that can inflate option prices would be a Fed announcement that's really being anticipated. What's the Fed going to do? Right before presidential elections, you're going to see a lot of inflated options because of the uncertainty that, what they could go. And again, it's uncertainty of a big move either way. But it's an event like those things, those can make it go either way. Now, there's also events that happen in news that comes out all the time that isn't known before. And this is where you have to be careful sometimes. If I'm sitting around and suddenly, a news story comes out that United Airlines is going to buy JetBlue. Well, there's a tendency sometimes when you're all alone at your house and you're watching TV and so news breaks like that, and you think that just because you're the only one in the room that you're the only one that heard that news. So you run to your computer to go buy call options on JetBlue because you know that stock's going to go up on the acquisition news. Well, guess what? Everyone knows about, and particularly the floor traders, they knew that news before you did because they pay to make sure they know breaking news before anybody else. they've already inflated those options. So you can bet that the call option you're about to buy has been inflated. Now, again, it doesn't mean that you can't make money on JetBlue options going up, call options going up in value on the acquisition news. But you better understand that that's a little bit riskier trade. I'm paying a little bit of that premium. I'm paying an extra premium for that option that just seconds ago was worth $7, and that's usually not big extreme amounts. I use the extreme amounts just to, that option that used to be $7 just immediately, just a few minutes ago, might be worth $7.75 right when that news broke. Now the risk, though, is let's say that you bought it, and then seconds later, did I say United, or I can't remember what airline I used, Delta or whatever. Let's say Delta came back out and said, no, that's a false rumor. We're not looking to buy JetBlue. Well, guess what's going to happen? That option is going to deflate. That market maker is going to deflate that option right back down, and now your option's back to $7. And so you lost money, even though the stock didn't make the big move, or didn't move, or even if it did move in your favor a little bit. So that's a frustrating thing when people trade earning announcements too, is that they buy that inflated option, and then the stock makes a not a huge move, but a decent move. And especially with out of the money options, you can practice it too. Go look at I don't know what company's reporting earnings this week, but find a company that's reporting earnings this week and look at an out of the money option on it, and buy that out of the money. Do it on paper. Buy the out of the money option on paper, and then wait for the earning announcement to come out. Even if that stock goes up, if it doesn't go up far enough. So in other words, what can happen is, let's say that stock's at $40. And you think it's going to go up on the earning announcement, and so you buy the $50 call option, and because it's inflated for that earning announcement, it's trading for, let's just say $7 or something like that. And that stock reports earnings, and it does move up. It moves up to $48. But remember, this entire price was extrinsic value. There's no intrinsic value to it. That option market maker might, after that news comes out, even though it made an $8 move, that option might only be worth $4 now or something like that. Because there's still time before expiration. Remember, a big part of that option, the extrinsic value, is time value. So there's still be some time value there. But you lost money even though the stock made an $8 move up. So that's what frustrates people when they trade especially when they speculate with out of the money options on earnings. Is they can't understand how on earth did I lose money when that stock went up $8? Well, that's how you bought an inflated option. Now, this could work in your favor. If you bought JetBlue options for $2 before that acquisition news came out, and then that stock exploded higher on the news, not only do you get to make the money on the option with the stock going higher, but that implied volatility goes into the option as well, inflates the option, and you can sell it for a lot more than what you bought it for. It works in your favor. Okay. So again, the key for today's class is just understanding that exists in that price. Now, most of the price of the extrinsic value is going to be time value. But I just want you to understand that if you're buying that option based off of some news event that just came out, or some rumor that's floating around there, chances are it's going to be an inflated option. And again, I'm not saying you can't make money with it, but you got to understand that it's a little bit riskier because you're buying an inflated option. And so if it doesn't move as much as you thought it was going to move, or you end up losing money even though the stock went up a little bit, that's hopefully you went into it understanding that that could happen. That's the point of why I'm teaching this, so you understood it could happen, and so that you can make an educated decision on whether to trade that option or not. Because I'd be a hypocrite if I said I've never traded inflated options, or I stay away from inflated options. I'll buy them all the time if I think the move based on that news is going to more than offset the risk of buying the inflated option, then I'll do it. An example of this too was yesterday, the options on the QQQ. I was going to buy some puts on the QQQ right before the market closed because the QQQ looked so bearish yesterday. And this is literally like 5 minutes before the market closed, and I went and looked at the options, and the options were expensive. They were probably about a good $1.50 more than they normally are. And I could recognize it just because I trade these options all the time, so I can tell a lot of times when they're a little bit more expensive. And so I now, if I was really convinced we were going to drop, I would have gone ahead and said, I don't care, I'm going to go ahead and buy it. But because of the erratic behavior of the market, I just told you earlier in the update that I haven't felt real confident in the market moving in any direction. So you throw on top of that an inflated option, I'm like, no, I'm not doing anything. And a good thing, because not only did it not go down, but it went up. And not only would I have lost money with the put option with the stock going up in value, but I would have lost if that implied volatility decreased at all, which it probably did with today's rally as well. So anyway, hopefully that made a little bit of sense. The last slide is just something we've already kind of talked about, which is the time value. Time value is the premium of the option. It's the biggest part of that extrinsic value. The key to this, I mentioned this last week or on Tuesday as well, that the further out you buy, you're going to pay for that additional time. That's the key thing to understand about time value, is that if you're going to go out a couple months, you can go out a couple months, but you're paying for that additional time. And so that doesn't mean that you're more likely to make money just because you're out further. Because if that stock doesn't make a big enough move in that period of time, or it moves sideways, it kind of goes sideways on you, you could lose a lot more money because you're paying for that additional time. Okay. All right. Next week, what I'm going to do, we'll kind of wrap up the option. Well, we'll wrap up this part of the buying, the option buying part of the class. The next class I want to go through and just kind of put it all together. I'll go over some of the rules of thumb of selecting a strike price and expiration date, and that kind of stuff. We'll kind of put all this stuff together, and then we'll have a couple of classes on selling options and being an option seller, and some of the risks and benefits of doing that. All right, thanks everyone. Have a great week. We'll see you Tuesday for the next market update. Bye now.